All right, Colin, how are you doing today?
Good, Harry. I'm glad to have you back. You know, two is better than one.
I am glad to be back. I don't know. We haven't published the episode that you did solo yet, so I haven't even listened to it. So we'll see how it goes. But if it did go well, hopefully I still have a slot. And today we've got a great guest with Amber. So I'm going to let you say hi and intro her.
Hi, Amber. Good to have you.
Awesome to be here. I'm excited to see both of you, Harry and Colin. We've been keeping in touch on Twitter for a while, so it's nice to get the chance to chat live.
Yeah, definitely. Honestly, we make most of our connections on Twitter, which is just crazy.
Same.
Twitter is a big part of this show, just by the way.
Yeah.
I've been surprised that the creep on the amount of deals I've done just from DMs on Twitter is going up. I'm getting close to 50%. And I don't know if I should be concerned or, excited by that, but definitely the egalitarian platform for getting in touch with people.
Definitely.
Well, let me do a little quick bio on you and get everyone to know you. So I'm excited about today. This is gonna be super fun. Amber is an angel investor turned solo general partner at the Council Fund. She invests in founders that are transforming traditional industries. Fund one that she did is about a $5 million target to invest in pre-seed and seed stage companies across vertical SaaS, Fintech, and healthcare. But before investing full-time, Amber obviously was angel investing, but also was a long-time operator. A leader at Eli Lilly, Apple, Snap, Cruise, Atmos. I mean, just like a great list of companies right there. So it makes me feel a little bit self-conscious about my background. But yeah, we're excited to dig in and learn about your journey. And I think we're going to start. Harry, you're going to ask a few of our few questions, and then I want to get into the journey part because I'm sure it's going to be a fun one to learn about.
Definitely. And Amber, I think I just realized why Colin is so excited to have you on. I think your journey mirrors exactly what Colin wants to do with his journey. So you're a little further ahead. So I'm pretty sure that's why
That's
he's
awesome.
so excited to chat. Would love to get to know you a little bit and your angel investment and investing general background. So I've got a few rapid fire questions if you're ready.
Yes, I'm ready.
All right. So how many angel investments have you made?
So I've made 30 angel investments and then 13 fund investments.
Okay, cool. How many angel investments have you made this year? Do you plan to make?
So once I launched my fund, I pivoted all investments to fund investments. So I've made 3 fund investments this year, and I plan to make 10.
Cool. And what's your average check size for the fund these days?
I write 50K to 100K checks into those rounds.
Cool. What was it when you were doing your angel checks?
It was more like 5K. That was my typical check size. So I started small.
All right. Ooh, we're gonna have to ask you about that because now you're writing the big checks. Okay.
Yes.
What type of startups do you look for and at what stage?
So I look for startups at primarily pre-seed. So as mentioned before, I invest at pre-seed and seed across vertical SaaS, fintech, and healthcare. However, right now I'm really interested in vertical SaaS and trying to stay as close to pre-seed as possible. And within vertical SaaS, I really love to nerd out and get excited about legacy industries. So the less sexy, the better. And when I say that, I'm talking about things like construction, logistics, supply chain, manufacturing. Believe it or not, having worked at all these tech companies throughout my career, it might seem like I've always worked on software, but actually behind the scenes, I was always interfacing with these legacy industries. So first half of my career was consumer electronics. Second half was like transportation, construction at Cruise and Atmos. And so all very software centric, but I had to work with these kind of outdated industries. And I saw that a lot of them are still functioning on spreadsheets, emails, phone calls, and sometimes even cash. So I see a lot of opportunity in them, and they're massive markets in their own right.
Got it. Yeah, that's interesting. I was going to say, because a lot of the companies you worked at recently, I don't know, they seem pretty sexy to me. Cruise, Snap,
on the
Apple.
outside, yes.
From the outside. But I guess what you were working on specifically were the less sexy parts of the business.
Many times, not always, but many times.
Okay. Interesting. So yeah, I really like that kind of idea about, and I think with my background, I spent a lot of time with the gig economy, and obviously there's a lot of attraction, for Uber and Lyft drivers. And I think truck drivers were a good example of kind of the opposite, like less sexy, but there are 3 million truck drivers. And I always thought to myself, like, wow, there's so much more investment happening with Uber and Lyft drivers in this other space. And they're kind of forgetting about these other sectors. Is there any one really good example that you think personifies as kind of like less sexy, the better type of company or product that you're looking for that you've invested in?
Yes, definitely. So one company that I just invested in is called SquareDash. They are building a SaaS platform and also some technology for roofers to be able to pay their contractors on time. And this is an example where a lot of them are using multiple like SaaS products inside of their businesses to run. So they might be using Gusto, Job Nimbus, other platforms, and really like they want to be out on the ground, helping their teams get jobs done. They don't want to be using like 10 different fragmented tools in order to manage their teams and run their business. And they're also still doing a lot of transactions and checks. They're waiting for insurance claims to clear. It's a very messy, long operational process. And so now they've kind of built their product into like threefold pieces. So number one, they're able to ingest information very quickly to produce the documentation that insurance companies need to process claims, which reduces a portion of the process from like 3 weeks down to 1 day. Then they have a SaaS platform to help these roofers understand their cash flow, which contractors they still owe money to, how fast those insurance claims are actually clearing and when they can pay them on time. And then they also have a cash advance product, which is more in the fintech space through a separate debt vehicle. And they are helping these roofing company owners actually pay their staff on time while they're waiting for those insurance claims to clear. So that makes a huge difference for them. It's a massive industry. It's also very, very cyclical or actually episodic versus cyclical. So even when the housing market is going up and down, people still need roofs over their head. So it's a massive opportunity. It's not the first area that you would have thought, like, let's go build a SaaS product. But once you start peeling back the onion, you're like, this is huge. People have hail and wind damage every single year, and then they need their roofs replaced every 10 years. And so there's a lot going on.
Very cool. Yeah, no, I like that example a lot. And I imagine construction in general is probably a lot of opportunity. Okay. Definitely. Also, I have one question too. So for those of us that missed our last episode, can you define vertical SaaS in case anyone doesn't know what it means?
I love questions like this because I love questions like this because anybody getting started with angel investing is hearing a ton of jargon right now, and there's no stupid questions. So
and also, luckily, I'm not afraid to ask the stupid questions. Colin is a smart one on this podcast. I just here to learn.
No, there is no stupid question. So SaaS, software as a service, people are buying subscriptions to this software. And when I say vertical versus horizontal, I mean that it's designed for a particular industry and a particular vertical. So instead of saying we're going to build the HR platform for any company in the world to use, or any company at enterprise level or any company at SMB level, that would be like horizontal because you're going across all these different industries. But vertical is like, I'm building the HR platform for logistics or for freight forwarders even, or I'm building like the procurement platform for, maybe it's like supply chain or like manufacturers in a certain area. And so it allows you to be a little bit more focused on somebody's day-to-day when you're designing the product for them.
Got it. Very cool.
Yeah. Awesome. Yeah, Nick went into ad nauseum detail about
I bet he did.
Which was great for I loved it. I was telling him I have like a similar thesis around marketplaces, and I kind of view SaaS and marketplaces as all kind of ending in the same spot. They're just coming at it from different directions in a particular vertical. Like one is like, hey, we'll monetize the transaction and add value that way for existing businesses. One is saying, hey, let's build the tooling, maybe a system of record, something that embeds, that ultimately enables huge amount of distribution to maybe have a marketplace or whatever it may be. They're all kind of end in the same spot. And it just depends on the industry if you want to embed first, like if that's the most advantageous way to go, solve a problem with software and give them something to do something with, or you help on the transaction side because they need demand or they need liquidity. So anyway, I love it. I love it too. I've become now that I've learned more about vertical SaaS, I'm becoming a fan quickly. Awesome. But I'd love to like jump into your journey. So we know you're an operator doing all kinds of crazy things at these companies, and it wasn't always super sexy, it sounds like. But what got you into angel investing? What, maybe talk us through the first one. Like, did somebody call you up and just write a check? Tell us more.
Yeah. Great question, because I know a lot of people where that's how they got started. They didn't realize they were making an angel investment and somebody asked them for one and they ended up doing it once and they're like, I want to keep doing that. My journey in was very different than that. I think I was raised by an entrepreneur of a small business. So my dad was an artist turned graphic designer, turned business owner for a digital ad agency in the late 90s and early 2000s. And so around my dinner table growing up, we were always talking about new partners, logos, brand designs, et cetera. And so I really got addicted to the building journey. But I also saw a lot of the ups and downs of the entrepreneurial journey, watched him navigate the 2008 recession and own that business for 15 years. And so it wasn't all like rainbows and butterflies. And so he really encouraged me, like, go a less risky path, study engineering, join a Fortune 500 company, like get a 401k, max it out, stay there for life. I tried to do that and it didn't feel right to me. I learned a lot at those companies, but I think that's why you'll see throughout my career, I went smaller and smaller and smaller all the way down to seed stage from there. But I had never really thought or really heard much about this venture scalable model. So I grew up in the Midwest and ended up moving out here for my job with Apple. And that was when, just by physically being in San Francisco, I started hearing all about these startups around me, all these entrepreneurs around me. And I learned about this new model where people were actually giving these entrepreneurs money to go build a software product that they could scale to millions of users and had multiple different distribution opportunities with. And I thought, I want to be part of that someday. That sounds like a really exciting place to be. And it was kind of the first time the light bulb went off to me, like, maybe I do want to get back to my entrepreneurial roots. And that's why I constantly want to join a smaller company. And so, but the issue then was that I couldn't afford it. I was earlier on in my career. And so I just started kind of studying venture capital and startups and reading TechCrunch articles, listening to podcasts. And I also started saving up because I knew I didn't want to jump over into VC in an associate role and work my way up the ladder because I was having fun in my operating career. And so I decided, I want to keep working, gain skills, build up my own net worth, and then someday start angel investing. And so I was very methodical about it. I waited until I'd gone through a high growth period at Apple, the IPO at Snap, and then I had made enough money that I wasn't like, independently wealthy and could leave my job and never work again. But I had made enough money that I could carve off a piece of my net worth and start investing that into startups. And so I didn't know where I was going to start, but I carved off, I think around 50K at that time. And I told myself, I'm not going to get my MBA. And so instead, I'm going to put that money into startups and learn in a different way. And I decided to invest in 30 companies over 3 years to see, A, am I any good at this? B, do I like it and would I want to do it full time? And then the rest, we can get into what happened next. But that was really kind of like that was why I got started. And then how I got started was really like I started just kind of looking around, asking questions, trying to find people that I could invest in because I literally had no deal flow to start. I didn't know many founders because I had been working at bigger companies. And so I actually started going to founder pitch events or things that I could find online and then chatting with the founders afterward and just telling them, hey, I'm trying to start angel investing and looking for other investors. And one founder was really, really nice to me. And she was like, you know what? I know some other women that are also operators like you, and they're having the same issue right now. They want to start investing outside of their full-time job. And they're looking for like a community to do it with and to build. And so ended up getting coffee with one of them, Courtney Bowie-Lipkin, who at that point was at First Round, and then Annabelle Lippincott-Paxsoy, who was previously at Open Door, and then working at a company called Assembly in San Francisco. And together, I came together with them and about 10 other members, and we started meeting every single month and hosting founder pitches back to back because we all kind of had like our own little pockets of deal flow. We all knew somebody from our job that was spinning out to form a company, or somebody from back in college that was starting a company. And so we brought those deals together, started considering them together, and then sharing our expertise working at different companies and different functions. And then while I was kind of getting my footing by doing that, I was also investing through a syndicate just to kind of get some reps in and learn certain parts of the process, even though I wouldn't be able to learn the full process through doing that.
Awesome. That's great info. I love how methodical you were. I think even in your, when we asked you our fire round, you mentioned you made 30 angel investments. And then here you said, okay, first year I took 50K. I want to do 10 checks a year. And I'm kind of doing the math in my head. I imagine you did 10 the first year, 10 the second, and 10 the third is what I'm guessing to get to that
exactly.
30 number. So I think it's pretty cool, seeing this approach, because I think a lot of the folks we've been interviewing, they kind of fell into it, or they discovered it, or they knew someone that was raising, or, oh, this person was amazing and starting a new company. And, I like that, you started from a place too, where, like you said, you had no deal flow and you kind of went out and got it yourself, I love the like sort of founder pitch event. And it seems like just sort of organically made a lot of connections and went from there, right?
Yep, absolutely. I think you just have to start asking around and putting the word out there that you're looking
Hmm.
to start investing. Also be careful what you ask for, because if you start putting it on your LinkedIn profile and stuff, you're going to get like, 20 messages a week from people that you want investment. And so when you're first getting started, that might be a lot, but I think looking for really high signal deal flow and thinking about
Yeah.
who's in my network that I could team up with, that would potentially be additive, and what can I add as well.
So LinkedIn, the sort of spam, you put angel investor on your profile on LinkedIn and you start getting all the inbound spam. Like, how do
Mhm.
you recommend people differentiate from like the high signal sort of potential founders and the ones where it's just like some, I don't know, I don't cold pitch on LinkedIn that, is obviously never going to go anywhere. But like, how do you think about that high signal and what do you look for? What do you recommend?
Yeah, so to be clear, I consider both. So I consider cold outreach
Hmm.
and warm referrals. That said, I have a network now. That group of 10 women back in like 2019, early 2019, has now become over 80 members. We all of them are working at companies like Square and Slack and Airbnb and Lyft, in different roles. And so we have really high signal deal flow. But I think of that as one of our channels. And
Yeah.
then I also have a lot of high signal deal flow now that people from my past jobs at Snap and Cruise and Atmos
Yeah.
know that I'm angel investing.
Hmm.
I hear from them first when they're launching a company, but I still do allow people to come and cold pitch their companies. I cannot keep track of all the LinkedIn DMs and the Twitter DMs. And so periodically I'll post on Twitter and just say, hey, if you're trying to pitch me, make sure you go to our form on our website.
Yeah.
But I have a really tiny team, and we every single Monday go through every single deal, whether it's been a warm referral or a cold outreach on our website. And it does get, the bar is higher for a cold outreach
Yeah.
to get an investment, because you like automatically we have to go an extra step in diligence because we don't know anybody that has a reference check on you. And so that's where it has to be worth it. There has to be a really awesome opportunity there. And maybe on paper that entrepreneur has great experience that's really relevant to what they're building. And that kind of tips me off. I should talk to this person. Like, they're building in a massive market. They are building something unique that's differentiated from others that I've seen in the space. And then that entrepreneur has some sort of unique insight likely. And so they might be the right person to build this business. And then I'll take a call with them and try to decide from there if those things are truly true.
Very cool. And you sort of teased at some of the work that you're doing with the fund. Before we get there, I have one last question for you on your sort of angel investing journey. Were there any challenges? Like, what was the biggest challenge or downside of the angel route? Because obviously you did kind of end up going and doing a fund. And I'm not sure if, you sort of saw that opportunity as bigger and better, or there was some aspects that you didn't like about angels. So feel free to share about that part.
Yeah, so there are things that I loved about being an angel. Number one, you're kind of like a free agent. If you want to take a high risk, like make a high risk decision on something,
Yeah.
and you don't want to do a lot of diligence, and you're just like, I met this person, I think they're awesome. I don't have a lot of time this week, and I want to write a quick check into it, just to see where it goes. That you can do as an angel. As a GP leading a fund with like 40 plus LPs that have backed me, I have, the responsibility to make sure that I'm doing proper due diligence on every deal. And that's fine. I'm fine with that. I knew I was going to have to do that going into it. But it's a different beast. And then I think the other thing that's not glamorous about being a fund manager, which a lot of people don't realize, is there's a huge like back office aspect to it. And so it's not just like, oh, every day I have this capital
Hmm.
that I can deploy into as many startups as I want. This is so great. That is the best part of the job, but
Yeah.
there's all these other pieces. You have to have a really crisp portfolio construction and constantly be considering like, is this, can I build a 10x fund with this one company based on this valuation and the future valuation I think it could be worth someday, and be like a lot more analytical with those decisions. And then the back office stuff is, you're managing a fund admin platform, you're trying to manage legal fees and keep them very low with a small
Yeah.
first time fund. And so you're taking on a lot of the like upfront work yourself, and just giving your lawyer like the last question on any changes you're trying to make. You're managing multiple business entities just for one fund. So there's a lot going on behind the scenes, writing quarterly updates. And so you have to be ready for that operational part of being a fund manager too. But to me, the main value add was like, I didn't have unlimited capital to just keep going for the rest of my life
Hmm.
as an angel investor. And so being able to take outside capital and find people that were mission aligned with me and believe in the thesis and believe in my track record leading into this fund, that allows me to have more capital to deploy in these startups, and even take up more ownership in these startups that I'm seeing. Like, I was writing really small checks into them because I'm limited by my own capital, but I knew I could be writing larger checks into them, and wanted to be able to do that. And so I'm pleased today that I have a group of LPs that's very easy to work with, and I feel lucky to have each one of them. But yes, it's running a whole business. It's not just investing in startups.
Got it. In terms of the fund, it was actually super useful. I like, people talk about fund construction, and I hear it and I'm like, I think I know what that means. Like, you probably want a good composition so you can have a great outcome, right?
Yeah.
And so maybe you can go into like just a little bit of detail, because I'm pulling the Harry here. I'm asking the questions about things I don't understand. But what are kind of the principles of like portfolio construction when you talk about it? I know you mentioned, can this company get to that valuation? I understand that part, but like, does that also mean spreading risk across different verticals? Like what does that like portfolio construction look like?
Yep. Yeah, so it's different for everyone. Everybody kind of thinks about what is their super skill and how is that going to feed into my portfolio construction? How am I going to win and have the best possible return with this fund? And so there are different flavors of it. My flavor, well, first I'll tell you the factors that you should consider. So number one, you want to consider, what's my follow-on strategy? Am I just investing in these companies once and trying to get as much ownership as possible and then riding out dilution for the rest of time? Or am I going to reserve a portion of this fund for follow-on investments in the companies that are hitting it out of the park, and write maybe a smaller check in initially, and then just keep doubling down every single time they're raising a follow-on round if they're meeting the goals and I believe in them and I still think that they're a high impact team at that point. And then the other thing you should think about is, how many companies do I want to fund with this fund? And for me, I thought about two different things. Number one, how many can I invest in each year with my own bandwidth and wanting to perform diligence on each one, and then also wanting to be able to support each one after I invest in them. And then the other thing I thought about with this was, how many vintages? Actually, I guess there's three things. How many companies do I want LPs to be exposed to? Because if I'm only investing in 5 companies, and 1 out of 10 companies is like the rule of thumb in terms of what could actually return a fund, 5 companies is probably not enough. And so I wanted to invest in 30 companies, because then we have 3 chances if 1 out of 10 is going to be a massive winner that buys back the entire fund and more. And so I wanted them to have access to 30 companies. And then the third thing is, I wanted them to have access to 3 different vintages in terms of the years that we're investing first checks into those companies. So if you think about it, every single year there's some sort of theme. And I'm not somebody that pivots to the new theme every year, but that theme affects the macro like ecosystem that these companies are launching out of. And so, back in the early days of COVID, the theme may have been telehealth, because like everybody's trying to move everything online. And maybe like future of work, because everybody's moving to remote. And then it was like the crypto Web3 craze, and everybody outside of crypto and Web3 was having trouble raising. Everybody inside of it was able to raise very quickly. And then the next year, this year, basically, it's been AI, which is, you could view it as a platform that a lot of things are going to launch out of, or you could view it as a feature that everything should include moving forward. And so, yeah, there's, every year there's something going on, and also just in the macro economy too. In 2021, it was a much easier time to raise money. 2022, not so easy at all. 2023, we've kind of reset to the new normal, and anybody going into founding a company now knows what they're getting into, is super gritty and has to be working on something important that they care about to even be doing this right now. And so I love that LPs that have invested in my fund are getting exposure to like late 2021, all of 2022, and then 2023, and a little bit of 2024, because they started like toward the end of one year. So those are the things I think about. Bandwidth, which I mentioned earlier, is a huge part of it, because I could have said, I want to have more shots on goal, and I want to invest in 50 to 100 companies. And I want to invest over 1 year in like 50 to 100 companies, so that I can raise my fund too and have a larger fund and more resources at play, which I have seen a lot of people do, and that's a strategy. But for me, I wanted to make sure that I just have the time to spend with each entrepreneur, to get to know them to the point where I can develop conviction and invest in them. And then also to support them after the check. So it's not just like I'm writing a check and disappearing every time they need something.
Yeah, I like that explanation. I think when I was going through the deck for your fund, I think you shared some good screenshots of text from founders, and it seems like you're quite hands-on, and I think it lends itself well to your personality and sort of, kind of also your goals. So I think it's kind of, again, I love how methodical you are in thinking about the fund construction, and sort of also, I think what's important for people is like, what fits your personality. Not like, I've talked to some people who are like, I love writing checks and help them quickly, and then I don't want to hear from them in the future, right? And it's like kind of understanding you don't have to do what someone else is doing, just like understand your personality. Now, one thing that I think is pretty different, obviously, from going angel investing to a fund, as you mentioned LPs a couple times now, and so you've got I believe a target. Is it 5 million that you've raised, or you're targeting 5 million for the fund?
Yeah, I'm targeting 5 million. I've raised about half of it, a little over
Okay,
half. So,
cool.
yeah, 40 LPs.
Awesome. So, how has that gone so far? And like, what's the sort of recommendation you would make for people that are thinking from going from the angel path to then going and doing a fund? Is, kind of raising from LPs, is that like the hardest part to think about, or, sort of build that network there and then kind of make the jump? Because it seems to me like that's the part that stands out to me. Because obviously, as an angel, like you
Yeah,
said, you can just write your own money. You don't have to, worry too much,
right.
or you can. And then now you have all these LPs who you're investing their money.
Yeah, fundraising is definitely the hardest part of the job. And
Hmm.
so that's something to definitely be aware of if you're thinking about raising your fund. It's a whole new work stream. And it's a little different than fundraising for a startup, where startups are like, I'm raising my seed round, I'm going to focus
Hmm.
on it this month, and then I'm going to get back to building. With a first time fund, I think the average fund, actually, I saw this stat from First Republic a little while ago. The average second time fund takes 18 months to raise. And so imagine, I haven't seen the actual stat on a first time fund,
Got to
but
be
I know a
longer,
lot of
right?
fund managers. Yeah, I know a lot of fund managers that have been at it for 2 years. And so,
Wow.
so it's like a longer, like slower burn, I would say, with fundraising. And you kind of start with your closest network. Like, these are the people I know. I started with my angel community that I built for the past like 4 years. They knew me, they knew my style. They were much easier to convert than people that have never met me before.
Hmm.
And then those lead to introductions, which lead to introductions. And the sphere of people that you're targeting gets much wider.
Yeah.
And then there are people that you just don't know anybody that knows them. And so you have to find people that know them and build, credibility with them in order to build credibility with some larger institution. And with a first time fund, you're also limited by the type of people that will invest in you. So
Mm.
big like pension funds, endowments that write multi-million dollar checks are probably not going to invest in a first time fund.
Got it.
They're a little bit more risk averse, and they consider everything to be emerging unless it's like your fund four. And so
Hmm.
if you think about it, like every fund, you're actually kind of you're changing your LP construction a little bit as well, because you're getting closer and closer to that like highly institutional group of LPs, which isn't going to invest in you. Maybe some of them will invest earlier on, but
Hmm.
it definitely will be hard to get a lot of them super early on. And so you're building those relationships over a long period of time. So even outside of that, like first fundraise for fund one, as soon as you're done raising it, you're already thinking like, okay, now how am I
Yeah,
going to prepare for the next gauntlet? Which is like you just got out of that one, and then it's like there's going to be another one coming that I need to start like warming up relationships for in like 3 months. So,
yeah,
and I
for
had
sure.
somebody. Luckily, somebody told me this at the start of my journey. They were like, just be prepared to be like fundraising for 5 to 7 years, because it doesn't get easier until you're on like fund 4 or 5, because finally you start seeing the results from fund one. Because it also is tough because you don't see like key KPIs for so many years
Right.
after you launch a fund. So yeah, so it's a beast. But I do feel humbled and happy that I've had the chance to do it, because for many years I've been on the other side of the table only,
Yeah.
which is, seeing somebody fundraise and share their pitch deck with me. And now I've been in their shoes, so to speak, raising from other people. And so able to be a little bit more empathetic for what they're going through.
For sure. And so, when it comes to the LP base for your fund so far, it sounds like you started with your close network, your angel group. Have you had most success there? Like, I'm an LP in a few funds, and I always see, oh, if you know anyone that can write a 250K check or 500K or more, let me know. And I'm like, I don't know anyone that can write
I
a
know.
500K check. Like, how do you
Yeah.
find those people in the next
Yes.
level? How are you doing it? Sort of, how's it gone for you personally so far? And then how do you kind of recommend people go about that?
Yeah, it's definitely it's difficult. So similar to what you just described, like most of my LPs that I had join early on were writing smaller checks into the
Hmm.
fund, maybe 50K, 25K here and there. And similarly, like if I were to ask many of them if they know somebody that can write a 250K to 500K check, they'd be like, no, but I can introduce you to somebody else that can write a 50K check like I did. And
Yeah.
so for a while, you just keep building momentum with that. eventually you hit somebody that does actually know, like one high net worth individual that is has so much capital, they're looking to deploy larger checks into entities such as yours, and they believe in emerging managers and the spaces you're investing in. And that's huge. And there are a lot of GPs at funds, larger funds that invest in emerging fund managers, but even they are doing it individually. So they might be more like writing a 50K check, but they know like larger LPs. And they can sometimes introduce you to those larger LPs after they've made their investment. And then there are also funds like big venture firms that have fund of funds programs, like Bain Capital Ventures has invested in the Council Fund. And they invest in a number of emerging managers that they think are strong. And for them, it's a source of deal flow. And so, you know, they've got like boots on the ground with all these different emerging fund managers who are super hungry to find the best deals and drive the best returns. And so that's part of their thesis. And there are all other venture firms that have that sort of strategy. And then once you get them on board, it's credibility to then, if you're talking to a family office or somebody who's outside of the tech like ecosystem, they see a name they recognize and it's like, oh, Bain Capital Ventures is backing you. That must mean that this is legitimate. So it's long. Honestly, it's a function of time and the time that you put in. It's like, it's not just a numbers game. It's almost like the time to get to know different groups of people and develop trust with them so that they will open up more doors for you.
Yeah, it's funny. I've had a couple of friends start funds, and one of them was raising a $20 million fund, the Earl Grey Capital folks. And I was like, oh, I know an LP that or fund to fund that could be an LP. Like, let me email them and see if they'll take, interested in talking with you. And because they were an investor in Outdoorsy. And so I emailed them and they were like, yeah, we typically write $100 million check. Is that going to fit with what they're raising? Right? And I was like, well, they're raising a $20 million fund. So that's going to be a little overkill. And anyway, it just was like one of these things. I was like, this is a whole different world. Like this whole fund to fund world, those are big checks and, they're mostly representing endowments and things like that. So
exactly.
Let's talk about the council, and not the fund, but the actual like angel. Yeah. The fun people, the people that want to get their hands dirty.
Did you say the fun people or the fund people?
I mean, probably both, but I don't know. I love the Angels personally, hence why we're here. But I want to learn a little bit more. Like, how does that work? Do they co-invest alongside? Share some details.
Yeah, so they co-invest alongside. I would think of as kind of a Venn diagram. So the fund has a very specific investment thesis where we're going after these early stage deals that are in legacy industries, all software focused. The angel group, every single angel has their own investment thesis and their own pocket of deal flow. And so we don't only limit them to the deals that we're considering for the fund. Like sometimes I'm sharing deals with them where I'm saying the fund is investing in this and we have extra allocation and the founder is, interested in adding strategic angels onto their cap table. Do you want to take a look? Other times they are, they're, seeing a deal in their network. It might be a fit for the fund. It might not. But if it's a strong deal, we'll allow them to share it through our platforms with other members. And the operation, like what it looks like is basically members join us. They go through an onboarding where we talk about founder etiquette. We talk about, all the different systems we use and how to engage. And then they basically every week or two, they get a newsletter in their email that has the top 2 to 3 deals that we're seeing, whether it's from member referrals, my background, co-investors that I've been working with for years, or like cold outreach. We share, top 2 or 3 between all those different channels with members. And then the following Tuesday, we actually meet up and we discuss them back to back. So anybody who can join at 12 p.m. Pacific, who's a member of the council, joins and we go through. And basically there we use our expertise. Everybody has their own expertise because we've got leaders in like legal, marketing, engineering, et cetera. And they will, highlight things that we should be considering about particular deals. If we have a supply chain expert in there, they might be like, I would be worried about this one angle of their business. You might want to double check that or ask this question if you're meeting with this founder. So everybody's focused on helping each other. Identifying questions we should be asking, identifying potential risks that we should be looking into, and even offering up connections. We've had angels offer up to me and other angels like, hey, if you get really serious about this deal, I know another VC that focuses only on this exact space and would have a lot of perspective to add, and so I can make an intro. And so it's really helpful for that. And then we also do a bunch of virtual and IRL events where we bring our angel group together. Sometimes we invite founders to join those sessions. Sometimes we bring in experts externally to talk about different things, like maybe we'll have a fintech expert, or we'll have a like an investing expert, like a GP at a larger fund, something like that, to go through specific topics with them. So that's kind of the membership like offering in the council. And then what's true about all of our members, even though our fund invests in everyone and our LPs are extremely diverse, men, women, people of all backgrounds, the angel community specifically is all female. And the reason we did that was because I've been on so many cap tables where I'm the only woman on the cap table, and I've had men and women coming to me saying, can you please introduce me to other women angels? Because like this cap table is like really, really a mess in terms of diversity. And so, but that said, like none of these women want to be on a cap table just because they're women. And so we want to be known as a community that's full of strategic operators, that every single person, if you added them to your cap table, would be value add. And so we want founders to think of us as somewhere where like you might get a check from the fund. I have operating experience and can help you. Or you might get a check from one of our angel investors or multiple angel investors, where you might meet like a go-to-market expert or somebody who led product market fit, at a different company, or helped think through a product-led growth strategy at a SaaS company like Slack. And so for founders, that's really important to have people they can call up, and we want to always be known as like that sort of like caliber of angel group. So that's the criteria to join the councils. Like we want you to be a serious operator, and you also have to be a woman.
So, and just to clarify, is it a syndicate or is it just people can invest individually? How does that work? Check size?
Yeah. Currently, people can invest individually unless it's a deal that the fund has previously invested in and we're opening up a syndicate. Usually we give our LPs first look at deals, and then if there's extra allocation, we would open it up to the angel group. And then members can also lead SPVs through the council. So if somebody came into the council and they're like, my coworker's leaving, founding a company, I'm already decided to invest in this company, I have a lot of conviction and I want to lead this deal through the council, we would position it to members as an SPV deal and do a carry share with them. And so they can actually earn, carry on the work that they're putting into the deal as well.
Yeah. And do you mind me asking, what platforms are you picking to run the fund and the SPV on, or SPV?
Man, so for the fund, I've been with Carta since day one. For SPVs, we've been playing around with a couple of different types of platforms. So I've used AngelList for some of our early syndicate deals, and then we're trying out Sidecar right now, which so far we like. So yeah.
Nice. I think that's like top of mind for a lot of angels out there, is like what to use. Also, I think your failure was also,
I know. Yes. I like Sidecar especially too. Colin knows I'm not I like to syndicate deals. I just don't like all the back and forth and kind of getting the money in, and
that
often
is the worst part.
End up like, I think it's really, I think people like really, even for me, like I think I have a decent network, but it's like I think people like kind of oversell how easy it is. Oh, just syndicate a deal, and it's like, wow, getting the allocation and getting the money. And Sidecar has,
it's like, I think,
4,500 in fees, so it's like at least reasonable, like to raise 50,000 and then have $8,000 in angel list fees. It's like, all right, well, there goes most of the investment. So I like that.
Exactly. Yep.
I love it personally. I don't know why. Maybe I just like herding cats, but
good for you. Yeah. I think I would like it more. I think I would like it more if I wasn't already running an angel community with like a separate operation. It's like adding something else on where it's like, okay, I have a fund, which is my number one priority, and then angel network. And then if I also layer on SPVs for every single deal we're sharing with them, it's going to get gnarly. And then, and also, I didn't launch the angel community specifically to be monetizing it necessarily. We do have membership fees, but it's basically to offer a great experience to members. And so for me, it's more important to see these women getting onto cap tables, and sometimes having their name directly on cap tables is actually important to them too. So, yeah, it's something I'm supportive of.
Nice. All right. It's time for the trending Twitter threads. Probably the most like the people's favorite segment, both guests and listeners, and Harry and I. But let's dive in. Harry will show a visual of it, but I'll read it. Let's start with
Matt. All right.
Okay, we're doing Matt. All right. So I'll read it out loud, Amber, and then we want your hot take. if that's good with you. So if you're an angel looking for alpha by investing in YC companies at demo day, you missed the boat by a mile and are attempting to play in a league that's well beyond your financial capacity to compete effectively. As an angel, your job is to invest before they get into YC. Now, I get it. We all want to be early. But also knowing what's going to get into YC seems a little like hard to know and what to do. So I don't know. I'm interested on your take here. There's a couple themes, but yeah, what do you think?
I absolutely love this question because there are so many takes on this topic. So number one, absolutely, the valuations are astronomical at demo day for Y Combinator, and I have actually passed on deals before because I didn't think it was worth it at that stage. I've seen multiple, even in this last batch, multiple companies that otherwise would have been considered pre-seed because they were pre-product or pre-revenue, but they were raising like top seed valuations. And so for me, it is important personally to get in really early because I have a pre-seed strategy with my fund. And that means I'm usually investing in sub 10 million valuations, and most of them cap out at like 8 million post. And so it makes a magnitude of difference in the end. If you're investing in like a 5 million cap company versus a $25 million cap company, that's a huge difference in your markup at like Series A, Series B, IPO. And so for me with a fund and trying to like provide a portfolio return on the fund versus on that individual startup, I want it to be a lot larger than a 5x return or 10x return even. I want to know that it could be 100x plus. And so sometimes, like for me, it is too late by the end of demo day. That said, it's not a blanket rule that I apply to everything. So if I met a founder that was in YC and they had a crazy valuation, maybe like 25 million post for something that was still pre-product or pre-revenue, but I had a really high signal on that founder and they were operating in an extremely large market and they had a really unique like distribution strategy and a way to get in quickly. I might consider something like that, but I have to believe that it's going to be like able to return the fund and like a 10x return. And even if I was an angel, like I'd be with my like previous portfolio, I'd be thinking like, could this return a 10x portfolio on all the other like 29 investments that I've made? So you just have to think through what's right for you. It is hard to determine who's going to get into YC. And so I think it comes down to if you feel comfortable having conviction at that stage. And I don't think everybody should be investing at pre-seed. I think it definitely takes insider knowledge to be able to invest in pre-seed. But I think if both of you are operators and there are probably operators listening to this podcast, I think that operators really do have a unique way in because they've been on the inside. They know what a successful company looks like. They also know what a successful founder and leadership team looks like. They may actually know some of these people. And if you know somebody that's a really high signal, if you know they're super capable and they're like top performer you used to work with, that could make something worth it. So I don't have a blanket rule, yes or no, but I would say like 80% of the time it's a no for me at the end of Y Combinator, unless it's like a super massive opportunity. And not just because of who else is investing, but because of the hard numbers that could actually be true about this company.
I like that. I find that really helpful. It's just like the dilution that comes even if you invest early on a YC company. It's just nuts. So I just don't. Yeah. I mean, unless they're really going to hit, right? I just don't understand how you even make money. It's a good thing, but it's also like a bad thing. I don't know. Like you want to invest in companies pre-seed early, then maintain a good ownership percentage, like not by having to do huge pro rata, right? You want to maintain it by the company being efficient about how they raise in the future. So it's an interesting angle I haven't thought a lot about in terms of my investments. Like, is this a founder that's going to just like go to funding to be their go-to way to grow, right?
Right.
Or are they going to build a business from the fundamentals that grows?
Yeah, definitely. I will say one of the advantages of Y Combinator is also the network that you build. So you're getting capital in the door, both from Y Combinator and then from people that invest at demo day. And so there are founders in there that for sure are playing that game of like, I'm just trying to get to Series A and then I'm just trying to get to Series B and I just want to always be raising at huge valuations. But there are also founders in there that are very methodical and they're very intentional about the investors they take on, intentional about the valuations. Obviously, they all want the high valuations. But yeah, I think some of them are doing it for the network too. And even like really awesome operators are like, I just don't know a lot of people in VC and I want to make this quick and painless. My first round out of the gate, I want it to be like really successful. So I understand why they do it, and I understand why it's value add for them. And I think it also depends on your check size as an angel too. Like if you're writing fairly large checks into these rounds, like a 100K check, you might be able to get more runway out of that if you invested previous to YC. But if you're investing smaller checks, that dilution is going to have like a bigger impact potentially on you over time. And so, and any fees if you're investing through like syndicates and stuff like that, you have to take into account. So, so I think it really depends, but it's a trade-off because you get more traction the more data you have, but then you get a better price with less traction. So you never know, both can work.
Got it. Cool. Well, last trending thread I will pull up on the screen right now, and it's from the other Harry in VC, much more famous Harry, Harry Stebbings. He says, when you think you've missed a true breakout company when investing, the worst thing to do, which everyone does, is try to find the next original that you missed. Don't do this. 99% of the time, gains accrue to the original. Swallow pride and invest at high price. Amber, what do you think?
So he's saying kind of try to find the next like competitor of that company. Do you think that's what he means by the next original, or just any other original company?
I think he's saying just because you missed it, you need to like going after the other ones probably won't be a dumb strategy. Go and invest in
he's
that.
Like, if you missed Uber, don't invest in the next competitor because you missed Uber, I think is what he's saying. And
so on this one,
he's British, so we got to translate, right?
Yeah. So yeah, in the Uber Lyft scenario, the people that invested in Lyft still did pretty well. Like obviously now, like Lyft and Uber are both having their issues in the public markets, but if you were able to sell via secondary or at IPO, you probably did pretty well, whether you invested in the first one or the second one. That said, that's an extremely risky bet to make early on. If you already see a company that's taking off like Uber. And so if you have the chance to invest after that at a slightly higher valuation and you turned your back on it before, I would say consider it if it still makes sense with your strategy and your portfolio construction. But otherwise, also be okay like leaving it behind. There will be like companies in your portfolio that you missed that were really good and they would have been awesome. So I think that's okay. Like I have an anti-portfolio that would have been, there's one company I always think about. I'm like, oh, why didn't I invest in that company?
What's the company?
Alloy, by Sarah Du. She pitched the council at her pre-seed like 3 years ago, or maybe 4 years ago. I don't know. It was like early pandemic, I think. And I knew at that point, I was like, this person is special. This company is awesome. This is going to take off. But I was feeling capital constrained that month. I had just invested in 2 other companies, which ended up being great markups in the portfolio. But I was like, I don't feel like I can write another 5K check this month, and maybe I'm getting too crazy. So let me just scale back. It was all mental, and it had nothing to do with her or the company. And then, like, of course, the company goes on to be super successful, ends up raising their next round from Andreessen Horowitz, and just did really well. So, and she's still doing well today. We still keep in touch, but and I tell her all the time, I'm like, this one is my biggest regret. So,
I guess to Harry's point, should you have just eaten your pride and invested at a higher valuation? Like
potentially, yes. I think I didn't realize it until it was too late. So like I knew that this one just got away from me as it was happening. But I didn't feel comfortable like that particular month, that particular quarter. I was like slowing down and like, okay, I want to just like see what I've learned in the last 10 investments before I keep investing at this speed. And then it turns out that was actually like a really special quarter. And like every single company that I invested in that quarter was actually amazing. And so that also taught me a lesson too. Like sometimes there are just these like particular quarters of the year or particular years where like everything is golden. And that doesn't mean there's something wrong. So, but I didn't
unfortunately
realize
you
that
can't have, sometimes it's like those hot deals, right? They come, all at once, or, they're not like perfectly evenly spaced out. I know I had a deal come up while I was on vacation last week, and even I was like, all right, gotta do a little extra work, even though I really didn't want to, but it was like something I was like, oh, this is too good to pass up. So really cool. Great insights, Amber. I love all of everything that you shared, the methodical approach and sort of the journey that you've taken from operator to angel and now running a fund and the group with the council. So if folks want to learn more about what you're up to, should they follow you on Twitter? It sounds like, I don't know if you're taking applications for the council, but feel free to let us know where we can find you. And we'll also include all those links in the show notes too.
Yeah, awesome. Yeah, I would love if anybody listening, if you want to keep in touch with me and what I'm building, you can follow me at Amber Illig on Twitter. It's just AMBERILLIG. Add me on LinkedIn. And then if you're interested in joining the angel community, we have our application on our website. If you're interested in pitching the council as a founder, we have an intake form on our website. And I kind of went over our process earlier, so you will actually hear something from us. And then if you're interested in becoming an LP in the fund, I'm still raising the next tranche, and that's coming together pretty quickly. So would love to have anybody on board that's interested.
Awesome. Cool. Well, we appreciate it, Amber. Take care.
Awesome. Thank you guys. Bye.